determination of whether material weaknesses exist. For the purposes of forming an opinion on the effectiveness of internal control over financial reporting, the auditor needs to evaluate the severity of each deficiency in internal control of financial reporting to determine whether the deficiency, now these are possibly significant deficiencies, as I mentioned before, individually or in combination, is a material weakness. Deficiencies can be material weaknesses. Material weaknesses don't have to be deficiencies. In performing these evaluations, the auditor should determine whether the deficiencies affect the same significant class of transactions, balances, disclosures, assertions, components, and if they collectively result in material weakness. What does all this mean? I want to give you a nice example. If we've got a weakness in the reconciliation, let's say we got 5 bank accounts and there's 2 bank accounts that have weaknesses. Now, those may be deficiencies in those 2 bank accounts, but do those collectively come together to make a big enough deal to say that, oh, we have a material weakness, which a material weakness, materiality, it affects the financial statements significantly, and that's a problem, right? That is what we'd be looking at there. That's our concern. A deficiency here, deficiency there in debt, in accounts receivable, could be a problem. Yeah, I mean, it's definitely a problem, but does it overall have an adverse material effect on the financial statements? That's what is important. So yes, you might have pain in your left toe. You might have you might hit your hand against the refrigerator. Those 2 things, they're not fun. They're not ideal at all. But have you hurt yourself enough where overall your body's just like, I need to lay down now? That's kind of what we're dealing with here. This is assessing that damage to the financial statements, just like you assess your damage to your aging body. Okay, the auditor should evaluate the effect of compensating controls. Now, these compensating controls, we'll go over them at a later lesson more in depth. Just like everything, this whole exam just ebbs and flows between itself. It's just a whole spider webbing effect. But compensating controls, just controls that exist there to compensate for weakness, for deficiency. The auditors need to evaluate the effect of these controls when determining whether a deficiency or a combination of deficiencies is a material weakness. Now, this is pulled directly from the AICPA authoritative literature. And while we talked about it, I want you to see this. I want you to understand this was highlighted pretty heavily because some compensating controls related to integrated audits would include things like having a strong internal audit function, maintaining robust internal controls. This is per the AICPA. And having a well-designed management control environment. So these are compensating controls that can catch if the individual account controls are not solid. So if the PP&E controls are not acting properly, if you've got strong internal audit function, right? Maybe within the warehouse department, there's a little bit of fraud going in there, so it's isolated there. Now, these compensating controls are to act as sort of catch-all and net to help catch these other problems. And well-designed control environment. We have good tone at the top. We have a lot of ethical people at our company. And if they see this, if they're diligent, hardworking, and perceptive, they may catch that fraud or that error in the inventory or warehousing department and account and make up for the fact that we don't have solid internal controls in our warehouse. The auditor should also test the operating effectiveness of these compensating controls, prevention, detection, correction. See this in BEC, see this in audit. Important here, each control you need to identify if it's a preventive control, detective, or corrective. Preventative would be having, with the warehouse, having badges to scan in, so you can't have someone go in there who's not authorized. Detective would be an analysis you do every month to see if someone entered the warehouse or if the inventory balances are not what they should be. And corrective would be just you taking action to correct the mistake. So implementing a new procedure to block the possible misstatement there. This compensating control can limit the severity of a deficiency and prevent it from being a material weakness. Again, within that specific deficiency in the warehouse, meaning that people are stealing things, if you have a solid internal audit department, the internal audit department could then detect that problem and any specifics. So compensating control could be an entity level, which is an overall for the entity. And if specifics in specific departments are failing, the overall entity level compensating control can limit these deficiencies and prevent a possible material weakness, which is a big deal. Material weakness, material misstatement, that's what we're trying to avoid. overall with all of our audit. Only compensating controls that operate at a high level of precision that would prevent or detect or correct are capable of having a mitigating effect. Although compensating controls can mitigate the effects of a deficiency, they do not eliminate the deficiency because it's still happening. It's still happening within that one department. Now, yes, you want these compensating controls, such as management reviewing the whole company every year or having a whistleblower hotline. You want these there to mitigate the effects, but you also want to be able to then go in and assess the individual smaller deficiencies within each department. If the AP department is cutting checks, writing checks to fraudulently cash them, that is a deficiency within the department. Hopefully, your entity level or compensating controls detect that, but then you have to go in and actually fix that yourself. Now, if the auditor initially determines that a deficiency or a combination of deficiencies is not a material weakness, so yes, there's a bunch of individual problems in individual departments, but they're not overall coming together to make a material weakness, the auditor should consider whether prudent officials having knowledge of the same facts and circumstances would reach the same conclusion. Essentially saying, take a step back. You've determined that this is not a big deal, but would other people think it's a big deal? If other people would think it's a big deal, then you should probably consider it a big deal yourself. Because there's a lot of subjectivity in audit, a lot of components like that. So this is how you would assess that, the actions you would take involving these material weaknesses.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.